Hello, and welcome to the weekly economic brief. My name is Dr. Lindsay Piegza, Chief Economist at Stifel. Last week, the Fed opted to take a more aggressive approach in the latest policy pivot, with the committee opting to cut rates 50 basis points and lowering the upper bound of the target range from 5.5% to 5%, marking the first rate cut since March of 2020. Despite the decision for a more sizable rate cut out of the gate, however, in the details of the statement, the committee made a somewhat positive assessment of conditions, noting growth continues to expand at a solid pace. And while acknowledging a somewhat slower pace of hiring, the statement notes a still low level of unemployment. On the inflation front, while the Fed has gained greater confidence that inflation is moving towards the committee's target of 2%, price pressures, the statement reads, remain elevated. As such, the Fed remains committed to supporting both the goals of maximum employment and stable prices, with the risks from both sides coming, quote, roughly into balance. The accompanying materials furthermore indicate expectations for an ongoing positive rate of growth, with the committee's GDP forecast slightly lower relative to June, albeit still notably above the longer run projection of 1.8% through at least 2027. The outlook for the labor market was also revised somewhat lower, with the unemployment rate expected to reach a peak of 4.4% in the current year, 0.2 higher than the June outlook, before subsiding, however, to 4.2% in 2027. Meanwhile, policymakers also acknowledged the ongoing battle with price pressures. The Fed's outlook for inflation was somewhat improved, with the pathway back to the target level presumably less steep, although the committee still maintains a long-standing forecast that price stability at 2% will not be met until 2026, some 2 years from now. Aside from the broader forecast, the dot plot offered a welcome quantification of policy expectations, with the majority of officials anticipating two more rate cuts by year end, up from one indicated in the June release, or a total of 50 basis points by year end, and a further 100 basis points in cuts in 2025, before reaching a longer term low of 2.9% in 26. The division in expectations, however, is notable, with 9 officials anticipating less than the median forecast. In fact, given this division, the decision between a 25 basis point and 50 basis point cut last week was likely a very close call, with ultimately 11 voting in favor and Governor Bowman issuing the sole dissent. Bottom line, meeting the market's expectations for a more rapid reversal in policy, the committee opted to cut rates 50 basis points out of the gate, a move Chair Powell described as, quote, a strong start. However, highlighting the healthy nature of the economy, still solid nature of the consumer and labor market conditions, along with the need for still further improvement in prices and little risk of a downturn, the statement struck a somewhat contrary, semi-hawkish tone in terms of underscoring the need for a patient stance and approach to policy going forward as the data continue to evolve. While a notably accelerated pathway to neutral relative to earlier expectations, the Fed's updated outlook still falls well shy of the market's expectations. In fact, as we've noted before, the biggest risk with a larger 50 basis point cut, as the Fed chose to implement last Wednesday, was always sending an inappropriate signal of the Fed's intentions to rush back to an accommodative stance and provide support to an ailing economy, as opposed to slowly unwinding policy firming back towards neutral as conditions normalize. As such, Chair Powell appears to already be attempting to backpedal or rein in market expectations, insisting the Fed is in no rush to cut rates, and furthermore insisting that half-point cuts should not be seen as the new pace of policy adjustments going forward, potentially leaving then further room to disappoint investors. Also last week on the economic calendar, the latest read on consumer activity indicated an ongoing level of strength in August, with retail sales unexpectedly rising. Now, the headline read on retail sales was far from impressive, with a minimal 1/10 of a percentage point increase for the month and a 2.1% annual gain, the weakest pace in 2 months. But coupled with upward revisions to last month's data, overall sales paint a much stronger picture heading into the end of the third quarter. In the details of the report, car sales fell 0.1 in August, following a 4.4% gain the month prior, and gasoline station sales dropped 1.2% for the month after a half a percentage point increase in July. Thus, excluding autos and gasoline, the most concentrated weakness, retail sales rose 0.2 for the month and 3.3% year over year for the second consecutive month. In fact, stripping out even more volatility and excluding food, autos, building materials, and gasoline station sales, and looking at control group sales, spending was even more robust, rising 0.3 in August and increasing nearly 4% on an annual basis, the largest increase since June. In the details, miscellaneous sales jumped 1.7%, non-store retailer sales gained 1.4, and health and personal care sales jumped 0.7. We also saw gains in sporting goods sales and building materials ticked up for the month. On the other hand, eating and drinking sales were flat, while general merchandise sales fell 0.3 due to a 1.1% drop in department store sales. Clothing sales, furniture sales, food and beverage sales, and electronics all posted monthly declines as well. Additionally, last week, an updated look at the housing market showed a somewhat surprising pickup in building activity. Housing starts rose nearly 10% in September, pulling the annual pace up to 1.4 million, a 4-month high. Year over year, housing starts rose nearly 4% in August, the largest gain in 6 months. Building permits also increased in August, rising nearly 5%. Year over year, however, building permits do remain in the red, off 6.7%, the 7th consecutive month of decline. This week, the economic calendar begins today with the Chicago Fed National Activity Index, followed by the S&P Global U.S. Manufacturing, Services, and Composite PMIs. Tomorrow, we'll take a look at the FHFA Home Price Index, along with the S&P Case-Shiller 20 City and National Home Price Indices, the Conference Board's Consumer Confidence Index, and the Richmond Fed Manufacturing Index for September. On Wednesday, we'll kick it off with weekly mortgage applications and August new home sales. Later in the week on Thursday, weekly jobless claims, along with a highlight for the week, the final Q2 GDP report. GDP was unexpectedly revised higher from a 2.8% gain to a read of 3% in the second round release, the largest increase in 2 quarters. In the final edition, Q2 GDP is expected to be revised down slightly to split the difference at 2.9%, still marking, however, a 2-quarter high. Also on Thursday, August durable goods orders, along with pending home sales and the Kansas City Fed Manufacturing Activity Index. And wrapping up the week, we'll take a look at the August Personal Income and Consumption Report on Friday, along with the PCE, the Fed's preferred inflation gauge. Personal consumption is expected to rise 0.3 in August and 5% on an annual basis, a potential downtick from the 5.3% pace in July, although still very solid on a nominal basis and well within the range established since May of 23. Income, meanwhile, is expected to rise 0.4 in August and 4.4% year over year, also marking a potential downtick from the July pace of 4.5%. And the PCE is expected to rise 0.1 in August, following a 0.2% gain the month prior and 2.3% on an annual basis, potentially marking a 0.2 of a percentage point decline from the pace reported in July. Stripping out food and energy, the core PCE is expected to rise 0.2 in August, following a similar gain the month prior, and potentially increase 2.7% year over year. Now, in this case, this would potentially mark an uptick from a 2.6% pace in July, and certainly pose a disappointing reality for Fed officials in the wake of the latest September rate cut announcement. Also on Friday, wholesale inventories and the final University of Michigan Consumer Sentiment Index read for September. And finally, on the FedSpeak front, breaking their silence in the aftermath of the September rate cut, we will hear from a number of Fed officials this week, including Atlanta's Bostic, Chicago Fed President Austan Goolsbee, Kashkari from Minneapolis, and even Chair Powell himself on Thursday, along with New York's Williams and Governor Barr, amid a somewhat mixed message from the Fed, with a more aggressive cut coupled with a somewhat hawkish statement and positive assessment of the economy. Investors will be anxious to hear further commentary regarding the decision and what it means for the pathway for rates going forward. And with that, I'd like to thank you for starting your week with Stifel.